All right. Hello. Hello, everybody. All right. Welcome back. Welcome back. Just like I told you, we are back right now with Ramona Thomas, who is going to talk to us today about our personal finance information. And we're just really excited to have her, really professional, really an expert in her field. And you don't want to miss what she has to say. So I'm going to ask you just right now to share with your friends, share with your loved ones, those of your family members and friends that you know are kind of going through a rough patch right now. Those are the people that want to see this program, want to know how to maneuver and have their finances just be maintained until we get out of this COVID state, right? So again, share with your friends and loved ones. You don't want to miss this information. It's very vital to those of us who want to not just survive, but come through this unscathed. So before we go any further, I'm going to introduce Ramona Thomas at this time, just to give us some tips, financial tips on how to go on through this. Ramona, I'm going to turn it over to you at this time.
Thank you, Phil. It's so great to be here during Financial Empowerment Week. So, thanks for having me. I'm really excited to talk about personal finance. And before I kind of jump into my slides, just to kind of give a little background about myself, I work as a financial advisor. So, I help individuals, families, and organizations really meet their financial goals. I spend time doing financial planning so that we kind of really know where. People should put their money. Like there are different places you can put your money. And so we really kind of do all of that around goals. And so I'm going to share my screen. I'm really excited to talk about personal finance today and hopefully be able to share some tips that people can use not only during the pandemic that we're in right now, but every day. Personal finance is something that's really important to us, whether we're in pandemic or not. I think one of the things that's really come up for people during this, some people who felt really right when we talk about emergency, finances. No one thinks of a pandemic. You think of full emergency. We don't really think about a pandemic. So today I'm going to talk about personal finance, and I want to kind of walk through our agenda today. Let's see if I can work the slides here. Okay, there we go. So today I'm going to talk about goals and why it's important to have financial goals. We're going to talk about budgeting. We're going to talk about debt and debt management and credit, which a lot of people around this nation are really dealing with. We're going to talk about saving, and I'm going to talk about investing. So those are the 5 topics on our agenda for today. We're going to start with goals. For me, everything starts with goals. It's kind of like think about your goals as a roadmap. It's setting the destination for where you want to go. And once you clarify where you want to go, then you can map out how to get there. There are a lot of different ways to get from here to Washington, D.C., for example, here meaning New York City. There are a lot of different ways you can travel. And so once you have an idea of where you want to go financially, it makes it easier for you to kind of map out your journey. Do you drive? Do you take the bus? Do you take a train? Do you get on a plane? There are a lot of different ways, different speeds, different costs of getting to where you want to go. So one of the things, oh, sorry about that. One of the things I want people to really think about and really spend some time on this is what are your financial goals? So if you think about this year, no one when we started 2020 expected we would be where we are today. But usually, around the end of the year, beginning of the year, people identify things that they want to get done. During the year, whether you call them resolutions or personal commitments or goals. And so when you're setting a financial goal, clarify what it is that you want to accomplish and do it within a specific time frame. I want to be a millionaire in my lifetime. That's pretty vague. But if you say I want to earn or achieve $1 million within a 5-year time frame or a 10-year time frame or a 2-year time frame, that's really specific. It gives you something to work with. And so if you think about a goal for 2020, someone might out there listening might be saying, you know what, I really just want to save $20,000. It's 2020. I want to save $20,000. So if that's something that you wanted to do, then you would think about $20,000 divided by 12. That's an average of $1,667 a month. So someone who started with a goal of $20,000 in the beginning of the year, we're now 7 months into the year. You should have about you should know where you are on that goal. If that was your goal, you should have about $11,667 left. So think about it. Some people want to pay off credit cards. Some people want to pay off a car loan. Some people want to pay off student loan debt. Like, it doesn't have to be saving. I mean, saving should always be a goal, but think about what it is that you want to do financially. Make sure that your goal is measurable, because you want to know where you're starting. If you look at sort of this image, sort of where you are at the beginning of your journey and where you want to end up, you want to be able to measure and track your progress. You want to know that it's attainable, right? Is it something within your current parameters in terms of what you make, what you owe, what you earn? Can you achieve that goal within the time frame that you're specifying, and whether it's a year, 5 years, or 10 years? And you want it to be realistic, right? So that I'm going to hit lotto, that only happens for a few people, right? I'm going to hit lotto and all my financial problems or challenges will be over. That if there's such a small percentage of the people in the country who win lotto, that shouldn't be your game plan. You should definitely have a plan that's more realistic, that doesn't really, count on odds that are against you for achieving your goals. So the one thing I want to say about this and why goals are so important is, if you don't know where you want to go, you won't know how to get there, and you won't know if you've ever arrived, right? So if you don't have a specific goal that you want to achieve, then it's hard to know when to get there. It's hard to have benchmarks. It's hard to be able to track it, because it's really amorphous. It's constantly changing. So you want to be able to make sure that you identify a goal that you can track and measure. So for those of you who are listening and watching, think about it. What is it that you'd like to accomplish? And, again, you can have goals that are long term, 10 years longer, 5 years longer. You can have a short term goal. You can have a goal for the month. You can have a goal for the year. I would encourage you to think about 2020. We are a little more than halfway over. But it's never too late to have a goal. So if you didn't really have any financial goals, or maybe you did, and you've been financially affected by the pandemic, perhaps you've been furloughed, or you work on commission, or you're a business owner and your business has really suffered or kind of taken a hit during the pandemic. So the goals that you had in January, you're not able to reach them because your revenue or your income is really changed during this time. It's still not too late. Think about between now and the end of December, you have a little over 5 months. What's reasonable? And again, it doesn't have to be on saving. It could be paying down a debt. It could be cutting some expenses. A lot of our lives have really changed during the pandemic. Many of us are still not commuting to work, where our finances are shifting. So money that we might have spent on transportation, we might be saving, or we might be spending on something else, like, more groceries, since we're cooking more at home. But sort of think about, what is it that you'd like to do between now and the end of the year? Write it down, make it visible to yourself, because it's going to constantly remind you of what it is that you're working toward, and then measure it. Think about, how will you know between now and the end of the year that you've achieved your goal? If it's a savings goal, you're going to see it in your account. If it's paying down a credit card, you're going to see that in your balance. If it's, a student loan, you're going to see that on your statement. So just really be clear about what it is that you'd like to do, and then, make a plan, set a strategy to do that. And I'm going to talk about more of that during the rest of our time together now. So the next thing I want to talk about is budgeting. And, what's really interesting to me is budgeting is such an important part of personal finance. It really is. But a lot of people don't use budgets. They don't create one. They don't use them. There's sort of a lot of anxiety or fear around, like, oh, I just can't do it. Like, I don't want to do it. It feels very limiting for some people. But here are some really key things about why you should have a budget. and why it's important part of your finance. And if whatever apprehension or angst or nervousness you have about having a budget, here are a few reasons why you should have one. It really helps you understand what's coming in and what's going out. So it helps you track your income. It helps you track what you're earning if you work a job, what your revenues are, if you own a business, if you work on commission and you get a commission check. It really helps you track what's coming in and what's going out. And you really want to be able to know, I make X amount of money each month and I have Y amount in expenses. And so that X minus Y equals Z. I was a math major in college, so I still think very much in math terms. That Z is what you have left over. And so budgeting is really important because it's really a tool that you can use to manage your money. So that you know how much you're bringing in. If you bring in 10,000 a month or 5,000 a month, you want to make sure that whatever it is that you're spending on your expenses is less than that. And that's where a lot of people get in trouble, is because we're spending more money, like more money is going out than what's coming in. And you'll say, well, Ramona, how is it that more money is going out than coming in? Because if you have credit cards or a line of credit or any means or opportunity in which you're borrowing money, it could be family or friends, but any means of opportunity where you're borrowing money, either on a credit card, either through a line of credit, family, friends, things like that, you're taking in that debt, that extra money, that extra income from another source, not income, but other revenue or money from other sources, and you're using it in ways that your income isn't able to cover. So when you see people who kind of run into debt challenges, it's not always because they lost their job or something happened. Often it's because people are living beyond their means, so they're spending 7,000 a month when they only earn six, and that over time really adds up if you don't have a plan to really pay for that. So when you think about your expenses and what you spend, there's sort of two different types of expenses. There's sort of your fixed or essential expenses. This is what you need to live. This is your rent, your mortgage, what you pay for groceries, utilities. It's kind of the things that keep your life moving every day. If you drive to work, it's your car note, it's gas. If you are paying student loans back, those tend to be fixed expenses. You know what amounts you're paying every month. So you want to make sure that you kind of have a handle on what your fixed expenses are, that every month you spend X amount on those living expenses, those essential expenses. And then we have what we call like lifestyle expenses or variable expenses. And think about it this way. These are kind of like, if you want to have an image of like a balloon, right? So as you make more money, maybe your lifestyle grows, right? You're able to do more things, and so you spend more money. And the opposite could be true as well. If your income shrinks, that your lifestyle expenses could shrink. So think about your lifestyle expenses as like travel. What kind of vacations, if you take vacations every year, it's your entertainment. Like, so when we were going to concerts before coronavirus, where did you sit in the arena? Did you sit in the first couple rows, or were you in the balcony, or do you not go at all? So think about entertainment, gifts, eating out. If you have hobbies, like if you golf, or if you are a gamer, you like video games. These are your lifestyle expenses, and your lifestyle expenses are really about what makes you you. They're about your interests, about the things that you love, the things that bring you joy, you and your family. And so, what's nice about lifestyle expenses, again, is that they can be elastic. They can kind of be like a rubber band. They can stretch when you have more money to stretch them. You can do more things. But if you need to contract and kind of bring them in, you can also, do that with your lifestyle expenses. So the reason budgeting is important is because you want to have a really clear understanding of what your fixed expenses are. Sort of, this is what I have to pay every month, and what your lifestyle or expenses are, and sort of where you have a little wiggle room, right? So if things are a little tight one month, you don't have to have all the streaming services. Excuse me. You can skip, the takeout, that weekend, or, for the month. There are some ways where you can kind of plug in those financial holes with your lifestyle expenses if you have to be able to do that. And I'm talking that way because my I suspect that there are a lot of people watching who, at some point during this pandemic, has been, affected financially. So I'm thinking about, those who've had to make some changes in the way that you live. So budgeting really helps you know your monthly expenses, what's coming in, and the key to all of this is really your cash flow. And when I talked about that X minus Y equals Z, Z is your cash flow. And your cash flow can be positive, meaning that you're spending less than what you bring in, which is great, right? Because then that gives you more money. Usually we would say to save and invest, and I'll talk about that in a minute. But being cash flow positive is wonderful. It kind of takes a lot of stress off. You have a little extra money to do the things that you like. But that Z, your cash flow, can also be negative. And again, Ramona, how in the world can I have a negative cash flow? I can only spend what I earn. Well, we live in a country where you can get credit. And if you get credit, you can spend more than what you earn. So that it is possible to have a negative cash flow, meaning that your expenses are more than what you bring in with your income. And that can lead to feelings of stress when you're, trying to figure out how in the world am I going to pay all these bills at the end of the month, and I really just don't have enough. And it can also lead to, trouble with, credit cards and, other things in which people who need like debt management services and supports, negative cash flow can often, lead to that. So, oftentimes people will say, well, Ramona, what should I be spending? I make this amount of money, but what's a good rule of thumb? Like, what should I be spending on, my fixed expenses? What should I be spending on my lifestyle expenses? How should I look at debt? And the answer to that is you're going to see different percentages. I don't know, and I don't necessarily agree that there's a one size fits all. So much of it's going to depend on the size of your family. If you're single versus a family of four or a family of six, if you're a couple with four children, who's also caring for elderly parents. I mean, that just there's so many family factors that really weigh into this, in terms of what you should be spending, and also where you live, and where you live geographically. Here in the Northeast, we live in the New York metropolitan area. It's a lot more expensive than you might experience living in the South, like if you live in the Carolinas or other places. And so so much of it is just it really is based on your situation and your circumstances. Generally, again, based on your income, you might sort of think of it this way: about 1/4 to 1/3 of your income goes to taxes. Um, that is an expense that's not elastic. It's not flexible. You have to pay the internal revenue, what they say you owe based on, your financial situation. But think about 25 to 33%, 30% of your income going to taxes. You want to think about saving around 1/5 of that, 20% of that. And I know people who, pay themselves first. You may have heard that. Pay yourself first. You want to save first. Some people will tithe or, pay a tenth to themselves. Others have different percentages. That's going to depend on your debt. You may hear 20% towards debt, but again, that will depend on how much you owe and how much you make. And then the remaining 35% would be your expenses. So that would be, how you live, your rent, your mortgage, the cell phone bill, the car note, gas, all of those kind of things. Those percentages are not hard and fast. They're not always easy to follow, but it is important. This is where budgeting can really help you. When you write those things down, you can see where your money's going every month. Is 40% going to your lifestyle or 50% going to your expenses? And are you saving zero? There are a lot of people who are not saving anything because they're just kind of eking by to make ends meet. And the last thing I'll say about budgeting is you can kind of go as high tech or as low tech as you're comfortable with. So in the image here, you have someone who's using a calculator and a paper. And that's a great place to start. If if you just want to start there, you can just write down everything you spend. You can kind of start putting things in some categories. Again, groceries, utilities, auto, rent, insurance, things like that. Then you can list out all of your other expenses. So one good place to start is you can look at June. Look for the month of June. We're almost near the end of July, and just look at what you brought in for the month of June. Look at what you spent for the month of June, and you can do it for the first 6 months of the year. That way it gives you a really good sense of what you've been doing financially during the first half of the year. And again, if you want to go high tech, there are a lot of software applications that you can use. Some are online, like Mint. Some are free, some are not. You can use Quicken. And the more high tech you go, they'll actually give you like these really pretty charts so you can see what percentages of your income is going to different categories. So, I just say start, for those of you who've been putting it off, like, oh man, Ramona, I know this is something I really need to do. If this is what you've been saying to yourself, then I'm here to tell you to start today. Just start with your budget, start in a way that makes you feel comfortable. And the more you do it, the more you'll continue to add to it. The key here is don't make a budget and then don't look at it again. When you make your budget, you have to use it. Use it regularly, and regularly is going to vary. I would say at minimum, look at it once a month. Maybe the beginning of the next month when you get your statements from your bank. It's a great time to just take an hour to look at your statements, check it against your accounts, and then you can kind of see, oh, in June or in July, like let's say you do it the first week of August, in July, I spent this much, I brought in this much. The key is when you create your budget, however you create it, use it regularly. For some people, that may be monthly. For others, you may do it when you get paid, right? If you get paid weekly, look at it weekly. Look at what you're spending, where you're spending it. If you get paid twice a month, you might do it around the times that you get paid, just so that you can kind of stay on track and update it, right? So if you have a budget where you're spending, $300 a month on groceries, look and see if that's what you're really spending. Are you spending less and are you spending more? If you're spending less, if you're spending 200 instead of 300, where are you putting that extra $100? That's going to be my question as a financial advisor. If you are spending $400 instead of $300, then I want to know, where did that extra $100 you're spending on groceries come from? These are the kinds of questions you should be thinking about in your personal finance, because this is, it's your money. This affects your lifestyle, your family. Okay, enough about budgeting. It's something that I like to do because it helps you, if you think about that roadmap, it helps you get to where you want to go. So now I'm going to talk about, and I kind of sort of started talking about debt and credit, but I'd like to share a couple of statistics with you. Over 40% of people who have student loans, who've gone to college, who have student loans, are not making payments on their loans. And this is really important because even though right now student loans are suspended, most student loan payments are suspended through September because of the pandemic. Even before the pandemic, student loan debt has become such a significant issue in our society, to the point where you have, students who are coming out of undergrad and who are coming out of graduate school, and some who are not finishing, who are carrying loans that they just can't pay back. And this becomes a challenge for a lot of reasons, in terms of, we talked about stress, but also, not being able to manage your debt affects your credit. And credit is a really important part of the way that we live. Having, good credit score, good credit rating is how, it determines, how much you pay in interest on your mortgage or your car loan, or what you're eligible to borrow if you want to start a business or anything like that. The other statistic I'll throw out there, not throw out there, but share is that just under 40% of households in this country have credit card debt. So almost 2 out of every 5 people. So if you're at lunch or dinner with 5 people, 2 people at that table have credit card debt. And again, debt and credit are an important part of how we live in this country. The key here is to just make sure that you're managing it in a way that it doesn't affect you negatively. So a couple of things about ways that you can manage your debt and credit. And again, I'm going to place this in the context of being in a pandemic again. So if you're unable to work, or if you've been furloughed, or just the income is low, here are some things that can help you. The key is know what you owe. Know your debt, know who you owe, know what you owe, and make a plan to pay it off. But Ramona, I'm not working right now. What should I do? Call your credit card companies, call the student loan companies, call your mortgage company, explain. Don't ignore the notices. Don't ignore the mail, the emails. Call them, get them on the phone, explain your situation. Many will try to work out a payment plan with you. Like that, just sort of be proactive. Is being proactive is much better than being reactive and having things happen to you. So as you know, for some of you, this may be really, really difficult. If you owe the IRS, whoever it is that you owe, call them and try to work it out. Try to come up with a payment plan that works for you. And then when you're able to work again, if you've been furloughed or things like that, then you can, get back to your normal payments. So the key, number one, know what you owe, know who you owe, and make a plan to pay it off. Again, this is where budgeting can be really helpful and sort of parsing out, what you're going to pay who in terms of, your debt. Um, so think about if you owe a mortgage, if you have a car loan, student loans, credit card debt, the key is to pay it off as much and as quickly as possible. And so if you're one of those people that has a lot of debt, there are a couple of different ways that you can tackle it. If you've heard of the snowball method, you can Google it. There's different strategies that you can pay down your debt. You can start with the lowest balance and pay that off first. And then as you pay that off, you move to the next lowest balance. You take the money from that lowest. So I'll use some concrete examples. Let's say you have 3 credit cards. One is 2,000, one is 3,000, one is 5,000. And you want to pay them down. There are 2 ways you can start. You can start with the lowest a balance, which would be the 2,000, or you could start with the one with the highest interest rate, because interest, especially on credit cards, can really hurt you because it's compounding. And it just makes it so much harder to pay it off, especially if you're doing minimum payments. But if you're doing the debt snowball and you're starting with the lowest balance, you're going to pay, let's say you're going to pay 4 payments of $500, and you're going to pay that off in 4 months. Once you pay off the $2,000 credit card, then you still have the other 2 credit cards. What you're going to do is take the money, that $500 that you were paying, the smaller balance, and you're going to add it to that next one. So let's say the credit card that has 3,000, when you were paying the 2,000 one, you were only paying 100. But now that the $2,000 credit card is paid off, you're going to add that 500 to the 100, which is 600, and you're going to pay that $3,000 credit card off faster. So debt snowball really can work for people. The key is, again, to be consistent and to make the payments and be really diligent about it and having a plan, to do that. So you can start by paying one debt at a time. Not saying don't pay the others, but you want to sort of really put your effort into that highest interest one or the lowest balance one. And what's nice about the snowball is that, or having that strategy for paying down your debt, is that it really gives you incentive, because you'll start to see it go down, especially when you pay off that lowest balance. It's like you'll feel motivated. People are like, yes, I can do it. I have clients who are like, yes, when you start seeing paid, checked off, account closed, it gives you incentive and motivation to start doing the next ones. For those who are struggling with credit card debt, this is another thing. When you start paying down your debt, don't charge it back. So I work with people who say, oh, yeah, I pay it off every month, but then I charge it back. It's like, okay, but that's interfering with your other goals. So the key here is when you are paying down credit card debt in particular, you want to stop charging. Cut up the cards, put them in the freezer. There are a lot of different strategies where you can just kind of out of sight, out of mind. So that way you're not undoing the work that you're doing and paying the credit cards down. There are a number of calculators on the internet that will help you, figure out what an optimal payment is to pay down the debt or off the debt. If you have a mortgage or a car note or credit cards, you can, look for calculators that it may be called like a snowball calculator or a debt payment calculator or a debt elimination calculator. You can Google those and just kind of find the one that makes sense for you. And a lot of them are so sophisticated, you can enter your payment. Like, so say you can only pay $200 a month. It'll tell you how long it's going to take for you to pay it off. Or if you say, hey, I really want to pay this off by next spring because I'm getting married, I want this gone before I get married, April 30th, 2021, you can put in the number of months you have left. In this case, it would be 9 months and what your balance is, and it would tell you what the monthly payments you'd have to make to pay off that balance. So there are a lot of resources, a lot of free resources out there on the internet that can really help you, pay down, your debt. I often get asked, and I'm going to just throw it out there, I often get asked about, a lot of the ads you hear around, debt consolidation and debt reduction. I personally haven't worked with clients who've done that. And so my philosophy, again, it's not 100% right, but I always advise working directly with your debtor, like your creditors, whoever it is that you owe, starting there. My sense is that it's worked for some people, but I don't know anyone personally who's gone through the debt consolidation. Like maybe some of the ads you're hearing on, the radio or TV or that you may see pop up on the internet. Just be really careful, do your research, do your diligence. You want to read the fine print and making sure that, you're really clear about what any fees or additional interest or penalties there may be in terms of whatever the time frame it is that they have you pay that off. And then you also want to make sure you understand how that affects your credit. So you just make sure you do your homework, and before you sign, you read everything. One other thing about, credit cards is you may often see the 0 APR promotional, like if you transfer a balance, that could work for people too. Like if you have a couple of credit cards and you want to consolidate them to one where you have 0% interest for a year, that if you can pay it off in a year, if that's going to give you a window, at least it stops the clock on interest. That can be another strategy as well. So the key here, and I'm going to summarize sort of the debt management stuff, is, pay in full every month, pay on time, because this definitely affects your credit rating. It affects your FICO score. So, pay on time, stop paying late fees. And if you're paying late fees, anything on a credit card, it can be anywhere from like $25 to $39, which could have been your payment. So pay on time, pay in full if you can't, pay more than the minimum payment, and then use your credit wisely. And most of us, know ourselves really well, adults, if we're really honest with ourselves. I have clients who tell me they know they love shopping, or, the clients who are, very frugal. Like, we know ourselves. So, try not to tempt yourself. If you know you like shopping, or you're incredibly generous, you're the one who always picks up the tab when you go out with your friends, start putting some things in place. If you have financial goals that don't include paying credit cards for the rest of your life, right? Start putting some things in place. Like if you know you're tempted to pick up the tab, just bring cash. Leave the credit cards at home, or give them to someone to hold, or cut them up until you pay them off. There are a lot of different things that we can do to help save ourselves. You save yourself from yourself, or save ourselves from ourselves when we know what our weaknesses are. So that's what I'll say about debt and credit. And for those of you who have questions, I'll definitely answer some of those at the end. The next thing I want to talk about is savings and why it's important to save. Um, Again, another statistic here, over 40% of people in this country do not have enough cash to cover a $400 emergency. So a $400 emergency can be dental work. It could be brakes on your car. It could be something that comes up unexpectedly today. And over 40%, again, over two out of five people could not pay for a $400 emergency. And my hunch, my sense is that during this pandemic, that may be higher, with the millions of people who are, currently unemployed or underemployed and, looking for work. So this really underscores the importance of having an emergency fund. And it's one of the things I always talk about with clients. It's one of the first things, if they don't already have one, it's one of the first things we will often do, because you just don't know what that emergency will be. And we often think of it as something tragic, like an accident or health. And it doesn't have to be that. I think, coronavirus COVID-19 has really shown us that an emergency can be something that, the whole world didn't anticipate. In this case, a highly contagious virus. So it is important to have an emergency fund or a cash reserve. We often recommend 3 to 6 months, maybe 3 months for a couple where both people are working, 6 months if you're single. But given, again, the economic uncertainty of how long the pandemic will go or it will last, and what the surges that we're experiencing, I've been recommending people have at least 9 to 12 months of an emergency fund. And when you think about, well, Ramona, what's a good rule? Is 25,000 enough? And you just 50,000, I just want to throw out a round number. I think 10,000 will do it. Here's how you want to think about your emergency fund. That 3 to 6 months should be covering your expenses. So when I talked earlier about your fixed expenses and your essential expenses, you want to be able to pay your bills for 3 to 6 months, or at least right now in the pandemic for 9 to 12 months. So you want to have a fund that allows you to do that in case you no longer have income coming in, or in case your income or revenue, if you run a business, is has gone down, decreased, or is temporarily halted. So the key around that is making sure that you save regularly. People that I work with know that savings is an important part of your strategy, of your financial plan, of your personal financial plan. And it's something that you should be doing every paycheck. One of the things that makes it hard to save is that many people earn their money, they spend their money, and then they save what's left over. And oftentimes that's zero, because the mindset is spend what you earn, right? So if you're bringing in 5,000 a month, you spend 5,000 a month, you're breaking even. That means that there's nothing left over for an emergency fund, for saving, for investing, for anything. And so when you hear the statistic of how many people are living from paycheck to paycheck, that's the mindset. I'm spending what I earn. I'm spending what I earn, and so there's nothing left over. What I work with people to do is whatever it is that you're earning through your business or through your job, you bring that in, and then we save first. So saving becomes the priority, not spending. So we save first, and then we spend what's left over. And that's a real big mindset shift. It doesn't sound like it, like, oh, Ramona, you just switched spending and saving. But the mindset that goes behind saving first before spending is a really big shift for a lot of people. But the key is to make sure that you save. I would advocate that you save before you spend, and that you do it regularly. And so, if you're able to save 20%, that was the percentage I shared earlier, great. Some people are not able to. If you're able to save 10% or 5%, start where you can. Your next paycheck, your next income check, start where you can. The key is to be consistent. Do it every single time. If you decide on a dollar amount that you're going to save $50 every paycheck, $100 every paycheck, 10% every paycheck, just do it consistently. Just like we have habits of spending, we want to have habits of saving. And we want to make sure that we are doing that regularly. And again, goals can really help you here. I had shared the example of having the 2020 goal of saving $20,000 a year as an example. Maybe it's 10,000, maybe it's 5,000 in light of the people who aren't working. Just the key is to have a goal, set milestones, and to do it regularly. And you can see where you are at the end of each month. Did I save what I said I was going to save? Save? Am I seeing that growth, in my savings account or wherever it is that you're putting that amount? So, if you fall in this statistic here, if you are one of the 44% of people who do not have enough to cover a $400 emergency, maybe that becomes your first milestone. I'm going to save $400 so that if a $400 emergency comes up, I have it. And then you can double from there. You can triple from there. But the key is to start somewhere. I think sometimes people are so overwhelmed by their financial situation that they don't start. They become paralyzed and they don't do anything. I am encouraging you to do something. After you watch this broadcast, do something. Set a financial goal, whether it's to pay down your debt, to save money for an emergency, to start tucking away an emergency fund, maybe calculating what your emergency fund should look like. Please have one action step that you're going to take when we're done with this broadcast. So the last thing I want to talk about is investing. Why it's important to invest. Hey, Ramona, I've been hearing a lot about the stock market. I don't know if I want to put my money in the stock market. I work really hard for my money. It's going up and down. I just don't know what all that means, or I know what it means, but I still want to figure out how I can use it to make money. So we're going to talk a little bit about why it's important to invest, and how investing is different from saving. We're going to talk about when you should invest. I can answer that one right now. You should invest now. You should always be investing in your future. And the key is start early. And then I'm going to talk about where do you put your money? I've heard different things about stocks. I've heard about bonds. I've heard about mutual funds. And this is the 101. This is a personal finance 101. So for those of you who knows what those things are, that's great. For those of you who don't, I'll try to make it, just really easy for you to digest and figure out how any of these options can really apply to you. So, Ramona, why should I invest? I've been hearing about the stock market volatility and, the economic uncertainty. And, I'm hearing now about second quarter earnings, and I'm hearing all this stuff about the Dow Jones and the S&P 500. I just don't know. I'm really comfortable with my money in my savings account. I see it. I can access it with my ATM card. I know it's there. Why should I be investing? Why should I think about investing? Investing is a way to grow your money long term. You want to think about, when we talked about your goals, your long-term goals. Investing is going to be one of the best ways to get you there. Think about it as a way of growing your assets, growing your money to achieve your goals long term. And think of long term as sort of the rest of your life. And so, but you say, but Ramona, I like my money in my savings account. I'm earning, interest. So let me share a reason. And this is one of the more compelling reasons of why I encourage people to invest. And it's called the Rule of 72. And essentially the Rule of 72, it tells you how long it's going to take to double your money. So let's say the average the average interest rate across the country right now on a savings account is 0.09%. So let's say you have $10,000 in your savings account and it's earning 0.09 interest. And you're saying, yes, I'm earning interest, Ramona. This is great. The rule of 72 says this: take the number 72, you're going to divide it by your interest rate, or what's called your rate of return. That's going to tell you how long it's going to take to double your money. So at 0.09%, it's not even a full percentage point. It's going to take you 800 years to double $10,000, or 800 years to double your money at that interest rate. I know, like, we have longevity and people are living longer. I don't know that anyone's living 800 years to double the money in their savings account. And this is where investing, and I'll talk a little bit more about how investing helps you double your money or grow your money faster. The rule of 72 also tells you the interest rate that you would need, or the rate of return you would need to double your money in a certain amount of time. So let's say you have money in your savings account, that same $10,000, and you want to double your money. You want to cut it from 800 years to 8 years, right? Let's say you're 32, you want to double your money by the time you're 40. What you would do is you take the number 72, you divide it by the number of years in which you want to double your money, and it tells you the rate of return that you would need to double your money in that amount of time. So if you have $10,000 in an account, you want to double that money in 8 years, you need to have a rate of return of 9%. And a rate of return of 9% will allow you to double your money in 8 years. Well, Ramona, where can I get a rate of return of 9%? Not in your savings account. That I can guarantee you. So this is why investing becomes really important, because it allows you to grow your assets at a faster rate depending on the vehicles that you use for investing, and it helps you really focus on your long-term goals. So the advice is invest. Yes, you should do it. There are a lot of different ways that you can do it and a lot of different places you can invest. But Ramona, when should I start investing? I haven't really done it before. I've been doing it, and I want to do more of it. The key is start as soon as possible. You want to start as young as possible, because of compounding interest. And this is another reason why investing is important. And compounding interest, you may know this from if you owe any credit cards, or if you have credit card debt, the interest accrues and it's always accruing on your balance. So when you have credit cards, that the 13% or 19%, whatever you're paying, gets added to what you charged. And that interest on that interest gets added each month. And investing works the same way. When you invest, and I'll stick with the example of the $10,000 at whatever rate of return that you're getting. So let's say it's 6%. You're gonna get a rate of return on top of what you earned the year before. So $10,000, 6%, you're going to have $10,600 at the end of 1 year. You earn another 6%, it's going to be 6% on the $10,600. And so when you're investing, the key here is that you want to start early. The later you start, the less time you have for that compounding interest and to really grow your investments long term. So there are a lot of different ways that you can invest, and some of you probably heard about them. So you can buy stocks, or you can invest in what's called the equity market. And essentially, when you buy a stock, you are buying ownership, or a piece of ownership in a company. So without naming any companies in particular, you hear about certain stocks going up or going down, and people who own those stocks are very interested in those numbers going up, because the appreciation in the value is an appreciation in their ownership of the company. So when you own stock in a company, it's percentage or ownership in that company, and it can yield a return in terms of the stock either appreciating in value or it can go down in depreciation in value. Another place where there are a lot of different stock companies that you can invest in. The second sort of vehicle for investing is what we call bonds or fixed income. And it's really a debt investment. And so the way to look at it is you're actually lending the company money by investing in them. So you may be investing $1,000 or $10,000 in a company through one of their bonds, or in the government. The government actually issues bonds. And so what you're doing is you're saying, I'm going to give you a fixed amount. And what they're guaranteeing you is that when they give you that amount, let's say it's $1,000 at the end of the year. So we're gonna invest in a debt or bond. I'm going to do $1,000, and at the end of the year, it has a return of 3% or an interest rate of 3%. So Ramona, at the end of the year, I'm going to give you $1,030 back. That's your return. So the difference with fixed income and bonds is that you're investing in a company or an agency like the government. It could be local government, it could be state level or federal, with a guarantee that you're going to receive a lump sum of money back. And the interest rate or the rate of return could be fixed, like it could be 3%, or it could vary. It could vary based on other situations, other things like the market or economic conditions. And so 1 year it may be 3%, the next year it could be 4%, 5%. But the idea is that interest rate can vary or it can be fixed. And so many companies use this as a way of leveraging capital to maybe do improvements or grow the business with the guarantee that they will, a promise that they will pay you back. Another investing vehicle is mutual funds. And so you may have heard about mutual funds for those of you who have 401ks, or if you have a retirement program through your job. If you work for a nonprofit, it's going to be called a 403B. If you work for like the railroad, it may be called a 457, or if you work for the state. But essentially, mutual funds are diversified. It's a diversified portfolio of stocks, bonds, or other securities, and it's professionally managed. So basically, a bunch of people will pool their resources and their money and invest in a fund, a mutual fund, and it's managed by a professional manager. So you have someone who's very knowledgeable about the markets, about the economy, and that manager is going to pick what companies to buy stock in, or what bonds to put money in. And so that manager is managing that mutual fund, and basically you can buy shares into that mutual fund. But you're in a pool with other investors. So often these are very common retirement vehicles. So if you have a 401k or 403b or any kind of retirement savings plan through your job, you may have the opportunity to invest in mutual funds. There are thousands of them. You have a lot of different options, and they tend to have a focus. So they may focus on growth, like really growing, sharp growth in growing the assets. They may focus on income. So they may invest in companies or in bonds that's going to yield a dividend. Dividend is sort of like a coupon payment, or it's part of your interest payment that you would get back each month. Some may focus on technology. They may focus on different industries like healthcare. But there are a lot of different mutual funds with a lot of different missions or purposes or goals. So that's another great way that you can invest for your future. And then the fourth, there are other categories, but the only other one I want to talk about today is what you may hear in terms of like alternatives. So you may hear about something like gold, investing in gold and silver, or crude oil, or natural gas. Often you may hear that in the financial report on the news. These fall into a category called commodities. And commodities fall into a category that we call alternative investments. So you have like your equity, your bonds, and you'll have alternative investments. And these tend to be used as what they call sort of like a buffer or a hedge against the other things here on the slide. So oftentimes when like you may hear like oil is down, and if oil is down, how that affects the market. And so you want to have alternatives to kind of buffer so that, you know, when one is going up, another may be going down, one's going down, the other may be going up, and some move in the same direction, some move in the opposite direction. The key here is that you want to have diversity. You don't want to put all your eggs in one basket. And so when you're thinking about investing, diversification is really important. So when you look at the pie chart, there are four sort of slices of the pie, the proportions of where you put your money. Like, so if we think of this biggest one as sort of equity and stock, that's going to depend a lot on your age. It's going to depend on your goals. It's going to depend on your risk tolerance. But the key is that you think of diversification or diversifying sort of where you put your money in those different baskets, like the stock basket, the bond basket, you know, mutual funds through your 401k or retirement savings and alternatives. You want to just make sure you're not putting all in one, right? So if the market is down and you have 100% stock, then that obviously is going to affect your portfolio. It's going to affect your net worth. But you want to sort of have your money diversified in different ways so that if something happens in the bond market, it doesn't necessarily affect, in theory, it doesn't necessarily affect what you have in your equity in your stock portfolio. So when we think about a portfolio, and we think of sort of four, what you may hear, asset classes. One is cash, even the other is equity or stocks. The third would be your fixed income or your bonds, and then the fourth would be alternatives. And in that would be your commodities, and then it could also mean investing in global or sort of non-US, sort of outside of the US, so investing in foreign markets as well. And sort of how you make the decision to invest, and I apologize, I realize now I'm kind of crashing a lot in here, but for those of you who do it or are thinking about it, there's sort of a couple of things that we pay attention to. One's your age. When you're younger, you have more time to save and invest, so you tend to, in general, can be a little more risky in your investment. The other is based on your risk tolerance, right? And that really goes back to the best way I can describe risk tolerance is there's sort of two ways. One, it's the degree to which you're willing to invest, knowing the possibility that your investment could lose money. So in plain English, it's your ability to stomach a loss. Investments are not guaranteed. And so typically when you invest, there is some risk that it may not yield what you expect. It may not grow at the rate that you expect, or it may actually lose money. So your risk tolerance is really your ability to stomach a loss. So you can be conservative, meaning, you know what, I don't mind a lower return, right? That 1%, that 2%, because that tends to be on the more fixed income bond side. I'm conservative because I really can't, Ramona, I can't lose any money ever. Like I can't take that risk. I work really hard for my money. I'm okay earning 1 or 2% because I know that it's guaranteed. You can be on the other end of the spectrum, which is aggressive. Hey, I want to make it. I want that return, that 9%, that 12%, 25%. Like I want the greatest return possible. Usually that means that comes with more risk. So usually when you see the opportunity for a higher rate of return, there's a higher risk of loss. And so you definitely want to kind of know your ability to stomach a loss, a 10% loss, a 15% loss, a 17% loss, like, some of the losses we were seeing in March when the economy was reacting to the stay-at-home and shelter-in-place orders. Or you can be somewhere in the middle. I'm okay taking a little risk for a little more reward, but I don't want to lose too much. And so there are different questionnaires. There are different ways to assess your risk tolerance. And you can be somewhere in between conservative and moderate, or you can be somewhere in between moderate and aggressive. But the key is to kind of know yourself and what you're able to tolerate in terms of losses. So when you're thinking about where to put your money and how much to invest and when and where, you definitely want to think about your age and you want to think about your risk tolerance. Age only because the older you are, the less time you have to grow. When we talked about the doubling your money or compound interest. And so the losses when you're older are a lot more devastating than when you're in your 20s. They're a lot more devastating in your 50s and 60s than when you're in your 20s where you have more time, to make that up. But I think the key here is that I definitely encourage people to invest. And there are a lot of, I didn't talk about real estate. There are other ways to invest, but the key is, investing allows more and greater appreciation than, just savings in your savings account. But the key is to stay invested. And with that, I am going to pause and stop and take questions if there are any in the chat or out there live. Would just love to be able to answer as many questions as I can.
Hey Ramona, thank you so much. Wow, I learned a lot, and I'm so happy now and grateful that I'll be able to actually work directly with you, and I'm excited to see what we can do with my finances.
Thank you.
So I have a couple of questions that we've kind of we're looking to ask you.
Sure.
So one of them comes from Oscar, and he's going to help me once he gets his microphone out of the shot. Can you recommend a good ledger? So I think what he's talking about is either paper or online, somewhere where you can put your numbers into, like your income and outgo, he says.
Sure. So on paper, you can use Excel. And if you're comfortable, most of us are using those applications. You can use Excel or the equivalent if you're using spreadsheets on Google. And you can what's nice about using a spreadsheet is there are a lot of different formulas you can use. So you can just have one that has all of your income. For those of you that work multiple jobs or have multiple streams of income, or you get commission, you can have one tab for that, and then you can have a list of all of your expenses. And what's nice is you can use different formulas. You can move it around in terms of categorizing. If you're going to use paper and pen, you can. I don't know of any paper ledgers anymore. I'm sorry, I don't.
Oh, did we lose her? No, there she is. You have to unmute. Ramona, I need you to unmute, please.
Yeah.
There you go.
So I don't know any paper ledgers I could recommend. I would say in terms of online, I personally use Quicken. You can use any of those other apps. If you don't want to pay for software, I would start with Excel or a spreadsheet. And then there are a lot of online ones like Mint. There are a number of apps that you can download on your phone that will let you enter your data, that can link to your bank accounts, that can start categorizing, your expenses and your income for you.
Awesome. Did that answer your question, Oscar?
Yes, it did. Can you guys hear me? Because I'm having trouble with this microphone.
Yes, we can.
We can hear you.
Oh, good. So, Ramona, I was one of those people that was $40,000 in debt, multiple credit cards, and we did our research, and I can't even remember the company we used, but they did that. They did that for us to get rid of all of our debt. And basically what they did was call the credit card companies and say, we are canceling their card. We need you to bring the interest rate down to like 4%, and we will pay it off completely. And we were able to get out of debt completely from a $40,000 hole. And now we pay off our credit card every month, so we don't have any interest. And again, once you start learning little tricks on how money flows, and this is why there are experts like you to speak to, because we're basically in the dark. We try this, we try that. Like, spend a couple of dollars, ask someone that knows what they're doing, and get it done right. And the amount we save by speaking to an expert, we can't put that into a category. It's like, yeah, let's do it right the first time.
I really appreciate that too, because what I hear you saying, there's also a peace of mind that comes with it, right? Because people are trying out there to figure things out for themselves. And sometimes working with someone who can help you navigate just makes it a lot easier. Oscar, do you mind if I ask you how long, like once they canceled and sort of put it in the payment plan option, how long did it take you to pay down or pay off the debt?
I can't remember offhand, but what the parts I do remember is when we'd pay off one card completely and do that snowball and take all that money we paid that and put it towards the second one. So I just have these little tiny memories of watching 6 credit cards go down to 4 credit cards, go down to 2 credit cards and down to 1. And you're like, damn, and it didn't take a little amount of time to build up that $40,000 debt, but it took a hell of a lot less time to get rid of it. So it again also depends on how far in debt you are. I mean, 40,000 for someone like, oh man, I could pay that off in 2 days. For me in my situation, 40,000 was like, I'm never ever going to pay this money off.
Well, that leads me into my question, if I can, Ramona. So I'm sure that there's a lot of people out there like myself, included, where we were talking about the money coming in and the money coming out. And at the end of the day, having 3 children for me as well, like I do want to give them the opportunity to do something. So is there any areas where a credit card is a positive thing, or like where you would recommend putting it on a credit card?
So, and I'm going to I forgot to say this. I'll be talking more about cash flow, so sort of how to manage what's coming in and out in our next session tomorrow. But in terms of answering your question, Mona, yes, credit cards are important. I mean, they're an important part of how we live. The management of them is the key, right? So many come with a lot of perks, right? You use a credit card, you can get rewards, you get money back, I would say, to the extent that you have an idea of what you can pay back, right? So if you have a credit card with a $5,000 limit and it's summertime, you want to do something with your kids, I'm going to say do it, because life is just so important. I think we're seeing so much of that during this pandemic. Like, I tell my clients this all the time. Yes, we're going to pay your debt down. We're going to save. We're going to do this, but you're not going to just eat noodles. You know what I mean? Like, you're not going to be restricted where your life is so severely impacted that it's not worth it. So the key is to balance, right? So you want to do something with your children. Maybe it's not something over the top, but something that feels manageable, right? What can you do within the city that feels affordable so that when the credit card comes in, that you can pay it, right? And if you can't pay it all at once, maybe you can pay half of it, right? So you pay half, you split it out. You're going to pay half this month and half that month, next month. But the key is you don't want to do something where you're adding on to it, and then by December, you've added a few more $1,000s in credit card debt and you're not sure how you're going to get it off.
Yeah, the worst part about credit card debt is if you have a $5,000 limit and you hit it, they increase it to a $10,000 limit. It just makes like, oh, you wait, you're at 5, we'll give you 10 now. Like, you don't have that, like, all right, I can only spend that much, because no, they'll kick it up for you. One of the things I wanted to talk about when you said saving money for retirement and planning ahead, I saw some numbers that scared the hell out of me, which is if you're planning to retire and planning to live 20 years after retirement, and if it's 2 people, and you're only going to spend $7 per meal, 3 meals a day, it works out to $307,000 you need to have in the bank just to eat 3 times a day. So, talk to Ramona when you're 4 years old and start that planning, because it just blew my mind when it, again, putting down numbers on paper so you can see what you're looking at, and to break down 20 years at 2 people, 3 meals a day at $7 and come out with $307,000. It shocks you into, okay, I need to do something yesterday.
It's true. And I think the key of sort of starting early, there are a lot you could start with your children in terms of investing and saving for them, not only for college, but, for their retirement. It's the hard thing is, and it goes back to mindset, when you're young, retirement just seems like so far off. When you've started your job, you're in your 20s, you think 65, 70, oh my gosh, I got plenty of time. But, time goes so fast. You blink, 10 years go by, you take a nap, 25 years have gone by, and before you know it, you're filing your retirement papers. And so I would say, and I say this to clients, don't get discouraged. If you're in your 30s and 40s and you haven't started saving, it's for retirement, it's still start today. Like, it's just never too late. Oscar, to address the point that you made about, the $7 per meal for a couple and how much you would need, a lot of retirement planning is really based on your lifestyle and your expenses. And so we do analyses that can actually help you see what your lifestyle expenses will look like in retirement, and then sort of where you are in terms of percentage on track. And then the goal from there is to identify strategies that can help you get, a higher percentage of being on track towards your retirement.
Well, I'm definitely going to have my kids watch this on Facebook later, because I think it's important. I have, saved some money for them, but now, we'll be talking investment. But I have one last question before I give it back to Phil, because, and this is, of personal interest, but just curiosity as well, because, like you said, we like to spend, we love to spend. So when you work with clients, what are the top 3 areas where you actually have to tell them to scale back? Like what are the areas where people spend where they're not, I wouldn't say consciously aware that they might be overspending?
So I don't go at the micro level, like, oh, you're spending too much on shoes or clothes or anything like that. And I didn't talk about taxes at all, but to kind of answer your question, one of the things I pay really close attention to is sort of how clients are saving. And I didn't go into this in terms of the saving and investments, but there are ways to help mitigate taxes. So there are certain places where you can taxes. So that's one of the things we really pay attention to, because taxes are always on everybody's minds. It's making sure that they're saving strategically and investing strategically that can help them from a tax perspective. But in terms of places, I think that for my clients, it's the ones that need the most help relative to your question is just managing the debt and saving at the same time. So by the time we start working together, they are kind of up to here. Like, I've had enough stressing about it and doing this on my own. Now we work out their financial plan and we come up with a strategy. And that in and of itself sort of brings the peace of mind. And it's the dual working on the savings, building the emergency fund while paying down the debt at the same time. That's usually the hardest part. And then once they make the decision and they start, and you start to see really quickly, like I have a client who gets it and she can see the difference. And she's like, okay. And she actually sent this to me recently. She's like, I took your advice, but in my own way. But now I get what you said. If I had paid my credit card down, like, I'm doing it now. I get it. And so, and sometimes it takes a little longer for people to see the advice come into play. But then once they get it, like how it's affecting their bottom line and how it's affecting the time that it takes to achieve their goals. And, for many clients, it's really about financial freedom. And that means different things to different people, right? But if a credit card is in the way between you and financial freedom, you're going to get it out the way because you want to know what it's like to reach your goals and not have to worry about the things that you've been worrying about.
One quick question. Mona, you have Robert Kiyosaki's game. What is that? Cash Flow, the game for family. Would you recommend that, especially if you have young kids, to start early on realizing where money is created, how it flows?
I think for children, from my perspective, the importance is to give them like a healthy paradigm around children, like around money. not the, oh, money doesn't grow on trees, not to create that atmosphere of guilt around money, like, oh, I just gave you $100, like, what did you spend it on? Like, just more to give them that the healthy money paradigm, and that money is designed to, as an exchange, money is designed to circulate, money is designed to come and go, and start there. And yes, when it comes to investment, my son he read Robert Kiyosaki's book when he was 13, 14, and my girls have both read the same book as well. So to start, developing that awareness of investment versus, savings, of cash flow, and understanding the cash flow. Yeah, absolutely. It's important to start. And like we were talking about building a school earlier behind the scenes here, and I think this is one thing that all high schools should be bringing in. And I know that Ramona actually runs a course for high school and volunteers, and teaches high school students how to balance a checkbook. Even, I don't know if we have checkbooks anymore, but it's just so important, because once they graduate, high school, a lot of people don't know, a lot of kids don't know how to balance their checkbook, or even how to set up a bank account or manage money, how to have a savings account. And so I think it's important to start young, as young as possible, even with, I don't know, taking out the trash, and here's $2, you save 20 cents and you can spend the rest. So just treating them those habits from an early age.
I actually forwarded the link to my son because he just bought a car. And so, it's really important that we learn, how to manage our debt, because that's really what it comes to. It's like, I remember when I went to college, and they had, when I got out of high school, went straight to college, and they had a lineup of banks just ready to give us credit cards.
Yeah.
I mean, I had a friend of mine that got a $10,000 credit card, a college student. What you going to do with a $10,000 credit card? Okay. So
run it up real quick.
And most of the time, I mean, at that time, we thought it was free money. It's like, oh, the guy's like, well, you don't have to make a payment for another, 30 days. Really? And that was it. I mean, let's go spending. And you treat all your friends, everybody, I'm buying, not realizing that there's a bill coming, right? So, I mean, this was great information, and I can't wait to reshare it. Everyone that's watching, please remember that Ramona is going to be on again tomorrow, and she's going to be talking about cash flow. Okay, so we want to know how to flow the cash, right? And,
Absolutely.
because again, I always believe that if you don't know where your money is going, then you have no control. And you're probably losing more money. You're probably losing more money than you're anticipating. And you don't know why you can't catch up. Why is it at the end of the week, I'm always out of money? People, I'm sure there are people out there that are just wondering, why do I keep running out of money? And this is great for that, Ramona. That's amazing. But we're not done yet, because our friend Oscar has a few tips for us as well. So I'm going to turn it over to him, because we are running out of time. So go ahead, Oscar, and let us know some of the things that you offer through the company that you promote.
Sure. What I'm going to do.
Excuse me, Oscar. I'm just gonna love you guys and leave you. Ramona, thank you so much. That was awesome. And I'll see you all tomorrow. Thank you so much, guys.
Thank you. Tomorrow.
Cool. I'm going to share my screen real quick. I'm probably going to be about 10 minutes, and 10 minutes up and done. And let me see my slideshow. Ooh. Can you guys see that?
Yes.
Okay, good. So real quick, what Ramona and I both do are anti-stress specialists. And we're getting stress from all over the place. And for me, my background real quick, I was a dental technician for 38 years, and very unceremoniously, the place went bankrupt. And I found myself 2 years ago, a lot like people are seeing themselves now after COVID, and 40 million people have no idea what to do, where to start, where to restart. Quick article I saw yesterday, Mike Molino from homeless to millionaire. A lot of people that have made a lot of money have really, really hit rock bottom and found a way out. And as somebody said the other day, there's not a lack of resources in this country. There's a lack of resourcefulness, because we have all the resources we need to bounce back and make it better than it was pre-COVID, because we've learned a lot about ourselves now. So real quick, what I did to pivot was I became a certified identity theft risk management specialist. I was interviewed on TV. We talked about with a partner of mine on cybersecurity. And that's my John Gotti look for like, listen, let me tell you how it really is. And what happened was I've learned a lot about identity theft, and what I do in my workshops is explain to people that people think this is identity theft. Some guy sitting in the basement doing some scamming, but this is what the phone looked like when this guy was what identity theft looked like. So real quick, identity theft looks like this now. This is worldwide. It impacts everyone. The records that are stolen daily is incredible. Way back in the Equifax, we had 147 million records stolen, and we thought that was the end of the world. It's exactly what it says here. Victims will be looking over their shoulders for the rest of their lives. So fast forward to today, 1.2 billion records stolen in November of last year, and the total for last year was 15 billion. Now, Mona, you're great at math. How many times does 325 million go into 15 billion? Because 325 million is the number of people living in this country. So when they say identity theft is not going to happen to me, rude awakening, it's already happened. It's just a matter of time finding out when your identity is used. And what I keep saying is your identity is not stolen, it is copied. And that's passport, social security, driver's license. All of these things are copied and being used. And like Ramona, unless you have someone in your corner that can fix it for you, it's an uphill battle. The lasting impact of the Equifax, the emotional toll of identity theft, always looking over your shoulder, trying to find out, when is it going to happen? This poor guy got arrested twice because of stolen driver's license. So, I can go on and tell you all the crazy things that are going on with identity theft, but it's out there. We need to mitigate it. If you try to fix it yourself, just the medical identity theft is $13,000 out of pocket to resolve. So again, you can call in another company. LifeLock does a great job of advertising, but they keep getting sued for not doing what they're supposed to do, which is fix your identity. So Morgan Wright, the U.S. Department State Senior Anti-Terrorism, when he was being interviewed, said, I use a company called ID Shield because they have actual investigators. And again, I keep saying, and what we talked about earlier, get someone that knows what they're doing to do the job you hire them for. This is our comparison between LifeLock and ID Shield. Everything in red is what you're overpaying for with their company and not getting any kind of resolution. So again, stress is what we're trying to get rid of. And as you know, Legal Shield and ID Shield are the two companies I'm working with right now. And this is another form of stress. Well, how many people have seen this? The way to get rid of it is we can submit a traffic ticket through our app. And if it's worse than that, we can call the law firm. And again, like Ramona says, but people say it's 2 o'clock in the morning. We have 24-hour access to a law firm. And it's one law firm per state for our company. So legal profession was expensive. It was unresponsive. It was unaccountable. What we did using the app and the Uber and the Netflix way of doing business is using that group buying power. Whereas Blockbuster, you would buy one video at a time. Netflix lets you stream. So we've made the disruptive marketing innovation from those other ways of doing business and brought it into legal services. So now you get a top law firm at your fingertip, and we get rid of that expensive, unresponsive, and unaccountable part, because Legal Shield, the actual company that runs all of this, is in Oklahoma, and they oversee every single law firm. And if you have a problem with your lawyer outside of Legal Shield, who do you go to? Legal Shield lets you go to corporate, and corporate will take care of it. This is the way I used it real quick. I had a problem with Toyota. They told me there's a door, don't let it hit you on the way out because your car is out of warranty. My law firm wrote them what I call a motivational letter because they thought I was treated unfairly. And all of a sudden, Toyota says, Mr. Capel, we're sorry for the inconvenience. And I got my money back for that. So other thing we do is we help fund Operation Underground Railroad, which is a nonprofit that hunts down sex traffickers for children and rescues children and rehabilitate them and arrest the traffickers, which makes me very happy. So your next step, call, write, email, send a pigeon to me with some questions, and I can help you on that. The other thing I will do if you're a business owner is run your website through a dark web search engine. This is a business I know, and they ended up with 30,000 records that were stolen over a period of time. And I do not fix this myself, but people that I work with, I will get people in touch with them and let them do all the remediation. This is my information. If you guys have questions, I'm sure Phil has also put information in there for you. If I can be of any service to you or anyone you know, please don't hesitate to call, unless it's after 10 o'clock at night. Thank you, Phil, for the form.
No problem. No problem, man. It is exciting, the things that we are doing here. And if you have any questions about what Phoenix National is about, this is exactly what it's about. It's a network of entrepreneurs that come together to help the public understand that they are not alone and that there's information out there that can help you get over your humps. All right. Everybody has a hump in their life, and we have ways and means you can either get around it, over it, or through it. We prefer around it. And so I'm excited that Ramona and Oscar have really come on board here to, make sure that you get informed and their services are available to you. So when you see the banner that's on the bottom of the screen, reach out to them because they're able to answer your questions and to help you further. So this is Finance Empowerment Week with Phoenix National Business Group. And so you don't want to miss what's coming up in the future for this week. You don't want to miss Farah, who's going to teach us, how to market our business. We have a credit repair guy that's going to be on here. He's going to talk to you about your credit. So everyone that you want to tune them in to these pages, our Life Skills University and our Phoenix National Business page. You really want to subscribe, you want to like, you want to share, because this information is vital and it is life-changing. So you really want to get the word out there, get everybody excited, because this is going to change your life. All right. I'm so glad for everyone that is watching. We're definitely going to see you tomorrow at 1:30. Ramona is going to be back and she's going to talk to us about how to manage our cash flow. All right. Everyone, take care. This is Phoenix National saying, see you.